Well, great. It's 11:01. Time to get going, I think. I've come back from holiday and I'm still doing very little work because I think Richard's going to be doing most of the talking this morning on the news side. But we're also talking to Craig Baker from Alliance Trust, who you may remember we caught up with last July. And so we'll be seeing what's been going on with that fund since. So as usual, if you want to ask questions, please just email me at jc@martin&co or stick them in the Q&A box as we go. And so without further ado, I shall start off with the news. And this week we're going to talk about VH Global, which is a relatively new renewable energy fund. Then Richard's going to talk about the European logistics funds, which are going great guns at the moment. And then an interesting ESG development from Standard Life Investments Property Income. So for VH Global first, it's 7 months old, so it was launched in February this year. It raised 250 million, which is obviously quite a lot. It was going for 400 million, and I think quite sort of soon we might see it coming back and asking for the rest, because it's already 92% invested. They've sort of been going about things as though they'd raised the full amount. So the project sizes are all quite large. Here's the chart. Obviously, there's not much history to it, but basically just showing that it's been trading at a premium ever since it launched. And that's still quite reasonable size. So I think that should help in terms of trying to raise more money. And there it is sitting in the sector. The way that it set up the dividend, it's only going to pay about 1% in the first year. That rises to 5% as it gets more fully invested. And then it'll be competing with the other sorts of funds in the same sort of scale. But there are some differences between it and some of the other ones, and they may allow it to achieve better capital growth. That's their plan. We'll have to wait and see how that works out in practice. So 250 million, reasonable size now, kind of still towards the lower end of the table. There are, I think, getting to be a few too many small funds here, but they are all out raising money at the moment. And as Jane talked about last week, there's even a 20th one coming, the Blackfinch one, if it manages to get away. So this is where the thing stood at the end of June. And as at that date, they'd only really made 2 investments. So this is probably oversimplistic. You can see it is global, United States and Brazil. And the deals that it's on since in Australia and the UK. And I'll talk about what's been investing in since. But the big thing, and is the differentiator for this thing, is the high proportion in construction assets. And that's where it thinks it can get the added value. By investing in things at an earlier stage, taking on slightly more risk, although most of the risk sits with the developers, you can actually get higher returns. So that's the plan anyway. So what have they done so far? In April, which is one of the seed assets that they announced when they were doing prospectus, they invested $61 million initially, and they committed to invest more money later on in some fuel storage tanks, which are down in Texas near the border with Mexico. And the plan with that is basically it imports high sulfur fuel from Mexico, puts that through the Texas refinery plants that take the sulfur out, and then that fuel goes on and gets sold. And the sort of environmentally friendly aspect of this is to remove the sulfur from your fuels, because if they just burn them in Mexico as high sulfur fuels, that actually is obviously quite bad for the environment. So doing this process helps. And the existing things are operational, and they're investing more money to expand the capacity there. In May, they announced a program of investment in Brazilian solar with 18 projects lined up, and they've been plowing their way through those ever since. They're sort of interesting projects. So mostly they've got an off-taker with agreement with industry, or I think with a telecoms company is actually taking quite a lot of the power that's how they can produce. So that's going reasonably well, we think. And then in August, they invested in Australian battery storage. So they've bought into 2 operational sites. I think one's in South Australia and others in Victoria. But they are planning to invest more as they go. Obviously, Australia's kind of famous for having a lot of wind, a lot of solar, big outage in the power grid. Elon Musk came along and offered to build a battery storage project. They need an awful lot more investment in that area too. So this is to help stabilise the grid, and this is the sort of thing that we need to do in the UK too, as we add more and more wind power and solar power into our generation capacity. But what's triggered this morning is the latest announcement of what they're doing in the UK. They're going to build 2 CHP combined heat and power plants for £78 million. So the 2 plants, one in Nottinghamshire, one in County Durham, will generate 45 megawatts between them, which is reasonable but not huge. They're going to be, so they are obviously yet to be constructed, although everything's been secured in terms of planning permissions and stuff. And they are gas powered, which you think, well, how does that fit with the sustainable objective for VH Global? Well, the reason that works is because they're going to capture the CO2 that's produced and sell that to industrial users. So there are various industrial processes that you can use carbon dioxide in, and this is going to be sort of linked up straight with those. So that removes the sort of polluting element of it. The power is going to be sold on long-term power purchase agreements. That is great news, really, is because, as we know, there's been a lot of uncertainty around the direction of power prices. At the moment, they are going up and seem to be set to carry on going up for a while. And one of the reasons for that is that the price of gas has been going up. And gas in the UK is important within the energy mix because it's one of the things that you can use to fire up at relatively short notice when you've got a deficit of supply from things like wind. So if the wind's not blowing, you can fire up a gas power plant within about an hour and offset it that way. They're not instant demand things, the way that the battery storage projects can be. So they don't do that sort of instant grid balancing stuff, but this peaking plant stuff, so switching it on as in when you need the supply, is quite lucrative. But you can also use this for baseload power too, if the economics made sense. And there's sort of a shortage of baseload power. But as we've taken coal out of the system, and as some of the nuclear is being decommissioned, there's a shortage of baseload power in the UK. And so I think actually these are probably going to be quite attractive assets. They think they can make more than 10% a year in terms of annual returns. And 10% is what the NAV target is, to answer Tim's question. That's a target, obviously not a promise. But if they can achieve those sorts of returns from this thing, there's actually quite obviously attractive investments. So I think with this deal announced, we should be looking for an announcement from them quite soon as to when we want to raise more money. So watch this space, I think. Now, that's enough from me for a minute, and we're going to hand over to Richard.
Yeah, thanks, James. Yeah, so the 2 listed European logistics funds both have proposed raising more capital this week. So that's Aberdeen Standard European Logistics and Tritax EuroBox. And as everyone probably aware, that sector has been going great guns during the pandemic and is set to continue. Both funds are pretty, although they're both European logistics, pretty different in their approach to growing. So firstly, ASLI, so they're targeting a £75 million raise, issue price of 109, which is a slight premium to their NAV, but quite a big discount to their price. And they're also proposing a share issuance program for the next 12 months of an extra 250 million shares. And they say they've got a pipeline, different sort of levels of due diligence on that, of about 165 million euros, mid-box and urban logistics assets. And there's also development opportunities within their current portfolio to expand sites and let them out to existing tenants in those. So that's what they're looking to do with that money. So far, they've been growing quite slowly, not really doing big issues, using finance, revolving credit facilities and things like that to buy single assets and then doing sort of a tap issue to pay that back down. So that's been their approach over the last sort of year or so, but now they're obviously ramping that up. Now they've got a pipeline in place. So on the next slide, you'll see the current portfolio. So it's just under 500 million, 16 assets. Like I said, they focus on mid-box, which is around the sort of 200,000 square foot, 300,000 square foot size, and urban, which are smaller, sort of parcel deliveries, so close to cities. They're in 5 countries at the moment, and diversified between tenants, as you can see there. And they've said the pipeline is all going to be in locations that they're actually in at the moment, but they are looking further afield, sort of Nordics. They pinpointed as a growth potential as well. So then on to Tritax EuroBox, a completely different approach to Aberdeen Standard, in that they've been doing big issues. They did one earlier this year in March, where they over 230 million, I think they raised then. They're looking to raise another 170 million this time, 200 million euros. There's quite a bit of a misprint there. It's 111.5p the issue price, which again is a premium to NAV, so that's good. And they've got a massive pipeline. This will go on to 2 German assets, which they're in quite late stages of due diligence on signing those, and they've got another 350 million in the pipeline to go. And they've got this big pipeline. They can grow quickly because they have this exclusive relationships with 2 European developers, where they get first refusal on their development pipeline. And these guys are massive. They've got massive land banks. One of them's called Dietz, and they're in Germany, and they own masses of lands in Germany. And so to have first refusal over that is a massive advantage for them. And the other one is called LCP, and they've again got land bank all over Europe. So that's how they've been growing quickly, and they're looking to obviously grow again quickly now. Their portfolio is valued at 1.3 billion, got 17 assets, and they're more focused on, I mean, those charts are a bit out of date now because they've made some more purchases, but they bought one in the Nordics as well, in Sweden recently. So they're in 7 countries, but they're focused on bigger properties than ASLI. So the real big ones that you see sort of let to Amazon and things like that, sort of 1 million square foot, which have totally different dynamics to the ones, the smaller size ones. So the European logistics is going great guns, like it is in the UK really, and that's all due to online retailing going through the roof, if you see it on the next slide, and also supply chain resilience. So COVID has accelerated those trends, as everyone probably knows. More online shopping while the shops have been closed. Those sort of trends are here to stay, but also on the supply chain side. So obviously a lot of companies were relying a bit too heavily on Asia on their supply chain, on the manufacturing side, and then when that was completely cut off at the start of the pandemic, they realized they need to sort of get some resilience into supply chain. So they've been nearshoring and reshoring those manufacturing facilities back to Europe, and that's caused a massive demand for these buildings. And then couple that with chronic lack of supply. I mean, it's not just the UK, across European markets, there's lack of supply for new and current stock, caused by various things, but sort of competing against residential uses is a big one, but also sort of land, getting planning permission, things like that is slow, and all manner of reasons. But when you combine the two, massive demand, low supply, it equals rental growth, and both of these funds reported that over the last year or so, massive rental growth, and is expected to do more. So that's why those two are growing. So that's really exciting. And then on to
just quickly before you go on, Richard.
Yeah.
There's somebody asking here. So ASLI share price fell by about 5% when the issue was announced.
Yeah.
Does that mean anything?
Well, it's because it was trading at a premium to what they're going to issue this new stock at. So I think that's what the reason for the drop. I mean, it's still. I looked this morning. I think it was at. I need to have another look, about 112. So it's still over what the issue price is going to be. So I think that was what the reason behind that sort of small drop.
Okay, cool.
And then on to Standard Life Investments Property Income. Now, they made a really interesting announcement on Monday regarding carbon offsetting and how they're going to approach that. So they bought a site in Scotland where for 7.5 million, where they're going to plant 1.5 million trees, which will be grant funded, they think, and that is expected to offset nearly 200,000 tonnes of carbon up to 2060, which is around 73% of their carbon footprint. And this is they're market leaders in this. I haven't seen another listed fund do this to this degree. So they're ahead of their game on this, and they are on most things. To be fair, they're managed by a guy called Jason Bagley, and he's very sort of forward thinking in his approach to things. And again, he's demonstrated that here. On the next slide, we'll see a bit more detail in that. So the fund has a carbon net zero strategy, which it's working towards, and has done several things so far to sort of work towards that. So within its portfolio at the moment, it's been selling some of the older assets, which will require a lot of capital expenditure and to bring it up to standard, and has been investing those proceeds into newer, greener properties, which will come with a bit of a price premium. But if you speak to the manager, he thinks that's well worth it looking into the future, because there'll be although there'll be a green premium on properties like this, there will also be a brown discount on the ones that aren't up to standard. So again, sort of forward thinking on that side of things. And they've also put a lot of PV on, especially their industrial portfolios, and it's quite a big portfolio of PV, which they're taking an income from as well. And then on the next slide, we'll see some sort of thoughts I've got about this sort of early mover advantage that I think they're gonna get from this. So the manager expects the cost of carbon offsetting to increase rapidly as it sort of is moving up the agenda, sort of net carbon zero. So getting in now at 7.5 million doesn't sound too bad, and he expects that land price to increase rapidly over the time that they hold it. That's not why they're doing it, but it's just one of the things he's looking at, is getting in there early while it's relatively cheap before it all sort of really escalates. And it's something the whole of the commercial real estate sector has got to get to grips with, when you consider that the sector contributes about 30 to 40% of global carbon emissions. All of the funds will have to start thinking about this if they're not already, and putting plans in place. Like I said, the value of the land should increase over time, but obviously they're not getting any rental income from this purchase. So it'll be interesting to see how investors sort of look at this. The share price hasn't moved since the announcement, so I don't know on that side of things, but it's got to be good. It's got to be good looking forward, especially with all the sort of ESG sort of ramping up over the next few years.
Okay, thank you. That's really interesting. couple more questions coming through on this. So just first going back to Tritax and Aberdeen.
Yeah.
Obviously, it's now the same management group.
Yeah.
Any chance that the funds will end up coming together, do you think?
Yeah, I was going to touch on this and then decided not to, but I've got a question now. But I mean, I think it makes sense to eventually, but like I was alluding to, completely different investment strategies. One's going big boxes, the other's going sort of mid and urban, which have completely different investor profiles, completely different occupiers looking at them. So if a occupier of a 1 million square foot fell down, there wouldn't be that many other occupiers to take that space, and it would take longer to let that. Whereas it's a bit more liquid in the smaller boxes, a lot more occupiers to take that space. But yeah,
strategy, yeah,
it does make sense if they did come together. I think obviously the Tritax was bought out by Aberdeen Standard. The Tritax management bought out by Aberdeen Standard, so they're sort of in the same boat now. So yeah, watch this space really. I wouldn't want to say one way or the other, but yeah, it could be likely.
Okay, cool. There's a question about the difference between EBOX and Boxer. So basically, I'll do this. So basically, there's a whole bunch of funds now where you can choose whether to buy them in euros, say, or sterling, or dollars or sterling. But actually, you're really buying the same shares in the same fund, and it's all identical. It's just the currency you're dealing in. So it doesn't make any difference at all to your returns or anything else, or dividends or anything. It should just be completely neutral. And the reason why platforms only offer one or the other is that there's a whole bunch of platforms that just really aren't set up to deal with currencies very well. So they much prefer you to buy the sterling line. That's why. There's also a question about the regulation around carbon offsets. I don't know if you've looked at that, Richard.
Yeah, I don't think there's any set regulation on them at the moment, but I'm sure that will likely change as we move forward. And then the other question there we've got on how it works. So they get things called PUIs, pending issuance units, and then they can transfer this into carbon offsets, carbon credits, sorry. And they asked there, they can sell these, but they're not going to. I spoke to the manager earlier, end of last week, and they're not planning to sell these. They're planning to offset these against the carbon emissions that its portfolio produces at the moment. So that's the plan, and every so often the land and that will get valued, and they'll obviously report that value, and they'll get sort of PUIs depending on how many trees are planted and things like that, which will then offset against their thing. But yeah, they can in theory sell these credits to other companies or anyone really, but yeah, no plan to do that at the moment.
Yeah, actually look out, because my QD view this week is on a new Foresight Forestry Fund, and I do think the carbon prices are going up. I think this is part of where they think they have to get their return from. Anyway, enough. We should now switch to the main event and bring in Craig. So thanks very much, Richard. Get back on the right screen, and there we go.